In the world of business, starting a new organization comes with its fair share of challenges. Making sure that you have a good product, the land, labor, and capital to stay afloat, and staying competitive within your industry is a daunting task. The likes of which that even veterans within the industry find it hard to maintain a handle on their market. So setting up shop as an entrepreneur is an all but impossible task, because all these problems are exacerbated by being a new competitor within a market. This all boils out in the data, as a whopping 45% of all startups fail within the first 5 years of operation, with an additional whopping 80% of all business failing in the long run. So how do large companies like Amazon, Google, and Facebook scale to the behemoths that they are under such conditions? Well, the answer to their success is a little institution called venture capitalism, a practice that was created by French businessman, soldier, Harvard professor, and venture capitalist George Doriot, the father of venture capitalism. This man founded the American Research and Development Corporation in 1945, establishing the foundation for the business model for all VC firms to come. A pool of legacy wealth, experience, and connection, all organized for the express goal of funding risky ventures that may be profitable, becoming one of the most influential institutions in America, as a whopping 43% of all publicly traded businesses are funded by one form of venture capital, and another 60 million people are employed by these firms, a trend that has been ever increasing since the birth of the institution, being a key component in the development of the internet, healthcare, and telecommunication system, making the influence of this institution undeniable. So, how do people like Elon, Bill, and Craig use this institution to their advantage? Well, let me explain how venture capitalism works. In a capitalist economy, pretty much anyone can start up a business as long as they follow the dictates of their bureaucratic rulers. And those who have ideas about how to best serve people could use their services to make money. To do this, a source of funding is needed though, because the process of convincing others that your services are needed and the process of fulfilling on those underlying promises is a resource-intensive one. This is where an entrepreneur runs into their first problem though, as the land, labor, and capital needed to make a business function is often a minimum requirement, and most entrepreneurs start off with virtually nothing. This is when financing comes in. Cut a couple deals, make a plan or two, and poof, all your problems go away. For sources of funding, you can rely on your friends and family members who believe in you. You could crowdfund and rely on community bargaining in order to get what you want, or you could fund your project through loans through a bank. These options are great in their own right, but lack many of the features that a venture capitalist firm would offer. If you want to build big, gaining enough funding through these sources is nigh impossible. And on the off chance you do have the funding, going these routes leave you without guidance, as everyone that you borrow from probably knows less about the industry than the entrepreneur that's borrowing themselves. Venture capitalist firms solve these problems because the people that you're borrowing from are not laymen or greedy bankers. They're really rich people who more often than not started in a similar situation as you, making for an ideal business relationship. If you have a good product and a plan to expand the processes to make that product, these people are your best bet. So all that's left to do for our hypothetical entrepreneur is to start, the process for which looks a little bit like this. Venture capital firms are more often than not created by business people who want to make more money. To achieve this goal, they look out into their community and network with high-income people in order to fund new projects. These people are called accredited investors, those who make over $200,000 per year for the last 2 years, as anyone who makes below that amount is deemed to be financially unstable enough to actually handle the venture. Through this networking, they entice the accredited investor to invest with the prospects of making even more money. The venture capital firm gets a small amount of money compared to the investment from the accredited investor, and they also get a small stake in the business. The venture capitalist, aka the accredited investor, gets an even larger share inside of the business, and the entrepreneur gets funding and expertise for their project, at the cost of anywhere between 25 to 50% of equity inside of their business. The funds comes in rounds, labeled A through E, which is intended to take an entrepreneur from startup phase to the pre-IPO phase, with each stage solving problems such as product development, market validation, marketing, the scaling of operations, and capturing market share. In the process, the entrepreneur will receive anywhere between $2 to $150 million per round in order to fund their venture, with the funding amount for each subsequent investment dependent on the performance of the former investment and the potential profitability for the future, resulting in a win for everyone in society, outside of the businessmen who have to compete with the new business model. The capitalist makes more money. The entrepreneur gets a new business. The wider community gets employment and new products. All is well. But does it really? Because this means of funding comes with its own complications and issues, as the market is truly competitive. First off, the industry that venture capitalists tend to invest in are those that have the potential for high growth and returns. So, if you're not in tech, finance, or healthcare, your prospects for getting funded are slim to none. Also, if you go into an industry that's competitive with the vanguard of wealth that is funding you, good luck. You see, these investors have no incentives outside of financial incentives, so they use their control over these industries to make a quick buck. And the process of making a quick buck is a very short-term way of thinking, a way of thinking that's very self-interested. This leaves the founders, employees, and the wider community at risk. With enough risk, you get backlash. And with enough backlash, you get wider harms. Prime examples being Zenefit, a company based in San Francisco that's supposed to help with HR management through their online platform, which had a problem with employees cheating in order to get their broker's license, with reports as high as 80% in some states of workers being unlicensed, with relevant parties blaming this level of incompetence on the monumental employee growth campaign that turned a 15-person organization into a 1,600-person organization in about 3 years. Or in the case of HomeJoy, a platform that connects home service providers to consumers, that in the process of trying to acquire consumers, heavily discounted their prices and heavily incentivized their employees to buy their own products in order to cook the books a little bit. Workers from Ubers en masse are known for setting up appointments with competitors and then canceling it in order to cause chaos. Companies like Theranos lie about their product's abilities to diagnose patients just through analyzing blood, a trick that companies such as Walgreens even fell for. This consistent misbehavior could be attributed to the business model itself. To meet the demands of the investor, who wants to see growth in the institutions that they partially own, pressure is put on entrepreneurs, managers, and eventually employees to ramp up business processes to unsustainable levels. In the fray of all these adjustments, malpractice becomes practice. What was once uncommon becomes common. My dear viewer, to expand so quickly, corners must be cut, lies must be told, and promises must be broken. And when everything breaks down, most people lose. The investor takes a hit to their savings. The entrepreneur takes a hit to their reputation. The community becomes pessimistic about future projects due to the failures of the past. Who does win though? The firms, of course. The firms that take a management fee despite what happens. But at the end of the day, these pressures will always exist, as starting a business is a risky proposition. And having money behind you does not increase the likelihood that you will succeed. What it does do is increase the payout if you do succeed. Maybe that's the point though, as the world of venture capitalism relies on the collective dreams of all who engage in it to make the world a more useful place. And the lessons that we can learn from these ventures may have some uses within themselves. Thanks for watching.